Welcome everybody. It's Wednesday, the 18th of November, 2020. I'm Rob Murphy, Head of Investment Companies at Edison, and we're delighted to bring this webinar to everybody on the new energy ecosystem. We've got a few slides of Dan's, which I'll skip over actually to start with, and we can you can review those at your leisure. They are basically just setting out the shift to the new sort of carbon targets and what that's going to mean, sort of setting the scene. Unfortunately, as I said, Dan's got a technical problem. And then we're getting to the meat of the presentation. We've got three really good presenters with us today. We're going to start with Chris Holmes, who is a partner at Foresight Group, and he's investment advisor.
Rob.
Yes.
Hi, Rob. It's Dan. I've just managed to get onto an audio link.
Okay.
So
excellent. Thanks, Dan. I'm just introducing. Yeah, I'm just introducing people, and then you can kick off and go through your slides. Then, okay. Yeah. So going back, Chris Holmes, investment advisor to JLEN Environmental Assets Group. He'll be followed by Ben Guest, managing director at Gresham House and head of the new energy division. He is the manager of Gresham House Energy Storage Fund. And then finally, Jonathan Maxwell, who's co-founder and CEO of SDCL, and he's chair of the investment committee of SDCL Energy Efficiency Income Trust. So the housekeeping is we're going to keep the presentations fairly short and punchy, 5 to 10 minutes. We have slides accompanying those. And following those, we'll go to Q&A. So we should have about 20 minutes for Q&A at the end. And people can either submit those using the sort of Q&A function down at the bottom, or you can raise your hand and then we can address those verbally, and if you unmute for those. That's it. So without further delay, we'll move on to Dan. Dan.
Thanks, Rob, and good afternoon from me to everyone else joining us today. As Rob says, we're delighted to have such an excellent panel here today, and I don't want to eat into their time too much, but I did think it was worth providing some context, setting out the main theme underpinning the need for investment in this sector and how these businesses are positioned relative to that theme and indeed each other. So decarbonisation clearly and specifically the need to get to net zero is the big overarching theme here. Net zero is a term that's often used loosely and inconsistently, but in effect it means reducing global greenhouse emissions to net zero by 2050. This target is based on the work of IPCC and designed to be consistent with limiting the rise in temperatures to 1.5 degrees. The deluge of news flow on other topics recently has really obscured some very significant strengthening of national commitments over the last few months. Europe and the UK are already committed to reach net zero, and legislation is currently being enacted in Europe. But in the last 2 months, we've seen additional pledges being made by China, Japan, and South Korea. And of course, the President-elect Biden's manifesto also contains net zero commitments in power as well. In short, nearly half the world's GDP has made net zero pledges in the last 2 months, thus bringing the total share of global GDP committed to net zero to 75%. There are big caveats here in terms of how commitments can be interpreted and if they can be delivered, etc. But clearly a big step forward in the level of policy ambition over the last 2 months, and we would expect more over the coming months and years. If you could just turn to the next slide. Okay, so what does that actually mean for the companies here and investors? The first thing to say that delivering net zero is a massive society-wide commitment. It's often described as an and scenario, i.e. it needs a transformation of the energy generation, transportation sector, changes to industrial processes, residential heating, demand response, efficiency, carbon capture, etc. All of this needs to be delivered simultaneously, and it needs to be delivered soon to stay within the 1.5 degree budget. And electricity is right at the heart of this change. So in order to deliver or decarbonise transport and residential heating, electricity has to be decarbonised first, in most scenarios by 2040, if not sooner. Even in the UK, where we have one of the lowest carbon grids, thanks to North Sea gas and wind turbines, that is a huge challenge. National Grid estimates that UK renewable capacity will need to more than double in the next 10 years and grow sixfold by 2050. Lots of talk today, obviously, about Boris's 10-point plan and specifically about hydrogen, green hydrogen. None of that happens without renewable capacity increases. So Chris may talk to some of these themes and how that plays out for his fund. The additional intermittency obviously creates system challenges, and the amount of storage will have to grow at a similar rate to renewables. Large chunk of that additional storage will be batteries, and Ben may talk to the implications of some of these trends for his fund as well. And finally, we'll also need, and this is sometimes perceived as a less glamorous, but in my view, equally vital part of the system, we need demand-side actions, greater efficiency to lower demand, and demand-side response to balance intermittency. And so Jonathan may talk to this. In short, delivering net zero requires actions across the supply chain, and these companies are very well positioned to benefit from these changes. So if we could just turn to the next slide. So at the same time, the power industry, like everyone else, has been battling COVID this year. Some of the effects of COVID might provide a glimpse of what the electricity system might look like in just a few years' time. It's seen fossil fuel demand for electricity fall by a third, wholesale prices fall by 40%, carbon intensity by over 20%. Meanwhile, the cost of balancing the system has risen by over 50%. Really quite dynamic change over the course of just a year due to COVID. And this is, in fact, what we should expect over the next few years and sustained at least over the next 2 decades if net zero is to be delivered. So with that sort of broader context, I'd like to take the opportunity to introduce our first speaker, Chris Holmes, investor advisor for JLEN Environmental Asset Groups. Chris, would you like to introduce the JLEN fund?
I certainly would. Thank you, Dan, and that's a good scene setter for the session this afternoon. So if you could turn to the next slide, just a quick overview of Foresight. You might know we transferred the advisory team to JLEN from John Lang to Foresight just over a year ago. The whole team's now fully integrated into the wider Foresight business, enjoying the benefits of a much larger organisation focused on fund management with £6.5 billion of AUM and close to 300 clean energy investments. Foresight clearly has a lot of experience in investing into and managing renewable energy and infrastructure assets. So turning to slide 3, a quick overview of JLEN before we dive into a bit more detail. JLEN is an environmental infrastructure fund with a broad investment mandate that enables us to consider quite a wide range of technologies and geographies, with a preference for predictable revenues that are backed by contracts or subsidy. As at 30th September, the portfolio comprised 32 assets across 5 technology sectors in onshore wind, solar, AD, waste and wastewater management, and most recently hydropower. And we believe we've strengthened our position as the most diversified fund within the listed renewable infrastructure sector. NAV for the last reporting period, noting that our interims are due to be published just next week, was 94 pence per share. And despite the challenges around COVID, which I'm sure we'll be talking about in more detail, we still delivered on our proposed dividend last year and declared an increase of 1.5% for the dividend this coming year. So if you turn to slide 4, this depicts where JLEN's assets are, very heavily weighted towards the UK, with 2 wind farms in France. Within the UK, we have a good geographic spread for our wind farms. The solar plants are naturally concentrated in the south and southwest, and our AD facilities are located in the arable counties of Norfolk, Lincolnshire and Oxfordshire, where the feedstock for those plants comes from. Turning to slide 5, ESG continues to be an important aspect of JLEN's activities. We're delighted that JLEN was awarded the Green Economy Mark by the London Stock Exchange and has won some industry awards for its focus in this area. 2 years ago, JLEN set out its approach in detail with its first ever ESG report. Last year, it sought to build from that foundation, and it incorporated a set of ESG objectives, which you can see on that slide there. And these really define the approach the fund wishes to take in all of its activities. And over the course of this year, the board will be developing a series of KPIs that can track performance against these to complement those KPIs that are already there for the fund. And we, sorry, going back just a little bit, so we continue to commission independent analysis undertaken by Aardvark, which are all available on the website. And you can see that really sort of backs up and adds credibility to the ESG statistics that you can see there in the bottom left corner. Slide 6 provides some portfolio analysis. So you can see in the pie charts there, wind is the largest segment, followed by AD and solar. And we see attractive opportunities more so in AD and other sectors, which I'll come on to, that all start to influence that. Still a relatively young portfolio, average remaining asset life just under 19 years, and a strong proportion of it the portfolio has inflation-linked revenues. 71% of distributions received by the fund have inflation-linked revenues as their source. And that really comes from the subsidies that back those up. Turning to slide 7, quite like this slide. It really does help to explain why a diversified portfolio can bring many benefits. Firstly, it reduces reliance on one weather resource, be it wind, sunshine, or rain. And as we all know, the British weather is pretty unpredictable. And over the last few years, we've certainly experienced more extreme weather patterns. Indeed, the Met Office will comment on that in terms of record-breaking heat and rain, alongside some other spells of cold and windy weather. So really a mixed bag. And the chart on the right-hand side shows the monthly production across the 4 asset classes as a percentage of their yearly total. You can see there that solar follows an expected pattern of peaking during the summer months. Wind has a higher production in the winter months. Hydro fluctuates throughout the year, depending on rainfall, of course, and AD output is really unaffected. There's that welcome steadiness that we see across the year. So it's for these reasons we really believe a diversified portfolio is a resilient one that can reduce the impact of these climatic variables. There's a few other benefits there on the left-hand side, but I know we're tight for time, so I will move on to slide 8. This is a quick case study, one of our hydro assets, representing 2 new sectors for the funds in hydropower and also battery storage. And Ben will come on to battery storage in a lot more detail, but this just gives you a feel for sort of a really diversified asset that we added across 2 sites, one of which has a co-located 1.2 megawatt battery that's really giving us some great insight into that market, which no doubt will inform us for possible further investments into this sector in due course. Slide 9, a little bit on outlook and pipeline. So, despite the current impact of COVID-19 on the renewable energy markets, and obviously some downward pressure on valuations, we haven't really seen any discernible slowdown in acquisition opportunities. I think there's still a lot of strong competition for this, but I think structures are getting more resilient. That they are building in the possible impacts of what we've seen in the last 6 to 9 months. But clearly, there's a lot of renewed optimism across economies, and as Dan highlighted in his slides at the start, we have our targets. We have our net zero by 2050 target in the UK, of course, and obviously the 10-step plan that came out today. So lots of opportunities as we see it, and with a broad investment mandate that JLEN has, we hope to be able to capture a lot of those. We think we'll still see some opportunities in hydro and AD, bioenergy as well, biomass energy from waste. But further ahead, it really makes sense for JLEN to be part of this energy transition, whether that's battery storage or whether it's decarbonising our transport infrastructure. We see some exciting opportunities there. So slide 10. Just in summary, we've built a diversified portfolio across 5 asset classes, which provides exposure to more than one renewable source of energy generation, as well as the steadiness of our AD assets. And ESG remains at the heart of our activities, and we continue to evolve the transparency and accountability of the fund through its reporting, its objectives, and the KPIs that I mentioned. And really, this sits alongside, and certainly not to the detriment of providing sustainable dividends and capital preservation to our shareholders. And that's a quick rattle through. Thank you.
Great, thanks, Chris. We'll move on to the next presenter, which is Ben Guest at Gresham House, talking about the Gresham House Energy Storage Fund. So welcome, Ben.
Hi, thank you very much, Rob. and a pleasure to follow Chris. So if we could launch straight into the exec summary, thanks very much. He beat me to it. I should say that we're actually in the middle of a fundraising, having just published a prospectus seeking up to 250 million, issuance of 250 million new ordinary shares. Going back a little bit, we IPO'd on the specialist fund segment of the London Stock Exchange in November 2018 and raised £100 million. And so far we've raised £238 million altogether. And we're currently fully deployed. We're the market leader in the UK. We'll shortly, in terms of closing final transactions for the year, be at £350 million of operational capacity. That compares with, as far as we can see, a next largest competitor at 100 megawatts. And our fundraising is for a pipeline of 485 megawatts, which will see us grow to 865 megawatts, all being well. So and there's a missing number in there, which is another project that's in construction from our existing pipeline for 30 megawatts. So we're chasing this opportunity hard. The reason is, for the next few lines, we've seen a big inflection point, actually, ironically, revealed due to the COVID lockdown. We have broadly always seen that at the moment we have a circa 1.1, 1.2 gigawatts of installed capacity of energy storage, and we see that needing to grow to 10 gigawatts by 2025. And that's really to avoid the cost of balancing multiplying. What happened during the lockdown was that the cost of balancing the system, which is essentially paying for flexible generation to come on, to fill in troughs, or to provide flexibility. So when you have overgeneration of renewables, in the absence of batteries, what National Grid actually has to do is to curtail renewables and then curtail them some more. And the reason they do that is because they have to bring on some gas-fired generation, because there's no energy storage capacity able to do what gas is currently doing, which is to be set at 300 out of a potential 400 megawatts per CCGT, combined cycle gas turbine, for it then to be able to dial it up and down by about 100 megawatts. And it does this every day of the year. But in the lockdown environment, where we happen to have about 30% growth in renewable generation and a collapse in demand of about 20%, we've really got a glimpse of the future. We had an environment where we had very high renewable generation as a percentage of demand, which proved to be very challenging to balance. And so as a result of that, we've seen a couple of sea changes. National Grid really like batteries, have always wanted to use them, have struggled to use them. And in the context of what we've seen National Grid procure a significant amount more in the form of frequency response, which has led to the launch of a new service in that area. I won't go into the details given the time. And have also been trialing batteries in the same environment that they procure gas in advance. And that is likely to unlock one-for-one the opportunity for batteries that gas are enjoying right now. And that's a multi-gigawatt market. And in the longer term environment, we see gas getting out of this mid-merit segment of the market, in that it can set the price at a middling price. And we'll see the overall volatility of the market unleashed due to the price being set either by very low-cost renewables or much more expensive flexible generation, which batteries will partake in. And so we'll see a volatility being the driver of the opportunity for energy storage. So I'll come back to that if I have time. The opportunity that we have now is to build out a pipeline acquire a pipeline of 485 megawatts over the next 12 to 18 months, having doubled the size of the fund annually since IPO, 70 megawatts at IPO, 174 at the end of last year, 350 at the end of this year, and seeking to double again and more in the next 12 to 18 months. We're targeting a total return of 8%. We target a 7p dividend, and it's expected to be fully cash covered in 2021. It won't be fully cash covered this year, but is at the moment on a run rate basis, simply because of deployment. We can drive growth because we're acquiring projects at greater IRRs than our current weighted average discount rate. We're acquiring projects at greater than 13% in our incremental pipeline. We've got very low leverage. We have a very high margin business model. Our incremental pipeline is expected to have a margin of 75 to 80%. And we do see the potential for discount rates to drift down if you see what's happened in renewables. So we're proud of what we've achieved so far, and we think that there's a lot of additional potential. Next slide, please, sir. So this is literally just a picture, just to give you an idea of what these things look like. We've got the project in the foreground. This is a 50 megawatt project that we actually acquired at the end of last year. And you've got the connection substation in the background. Most of our projects are actually in industrial settings, but this is, being the prettiest, the one we thought we'd share. Next slide, please. Again, I'll leave you to read this in your own time. There's no big surprises here in terms of what's on this page. The only difference here is energy storage being introduced, and to highlight that we build large scale in front of the meter systems. So we build them on the left-hand side of this picture rather than behind the meter on the right-hand side of the picture. This is just the business model we've chosen to adopt. It gives us the opportunity to build large scale projects, which are increasingly at 50 to 100 megawatt scale. Next slide, sir. Thank you. These are all very obvious points. The point to highlight here, you can see renewables, in particular wind and solar, growing in the green segment. The point to make, which is very specific to the UK, every country will have an energy storage opportunity. This point to make about the UK is that we have a specific weather pattern and a specific deployment of renewable technology, which creates a trading opportunity which is unique to the UK. Not unique in that it won't be seen elsewhere, but it's specific to the UK. And the green segment, in quarterly averages, you see there, in real time, it can be over twice as large or very close to zero. And it is that feature of the market that creates the volatility that's available for us to take advantage of. I'll pause. Next slide, please. This is a very quick summary of our business model. The trading is where we're responding to commercial signals, either through the pricing created by what I've just described, or by offering our battery to National Grid to basically use our battery to balance the system in the hour prior to any half hour. The other mode of operation is frequency response, where we're taking power on and off the grid, in and out of the grid, purely to help deal with the small ripples on the surface, as we call them, in terms of the minor imbalances which manifest as frequency deviations. A high frequency, too much power, we take some off, and we end up with a very undulating profile to our power usage. A trading environment is much more of a square wave, where we're importing at full power or exporting at full power to take advantage of the commercial opportunity at that moment in time. We do have a level of contracted revenue, which is only 5 to 10%, but is very attractive nonetheless to have, and covers most of our cost base. It's growing towards 10% of our total revenues. Not much. I'm conscious that the time is short, so I'll go to the next slide, please. So as we grow, we're building a diversified and, well, no pun intended, powerful network of energy storage systems. While there's a national opportunity to balance the grid nationally, and this is everything I've been talking about, whether we're doing it at a wholesale market level or within the balancing mechanism, which is really the set of processes the National Grid goes through. Just for background, it's National Grid's job to make sure that the power supply and demand is well balanced at any moment in time. So in sub-second time frames, all the way out to much longer time frames. That is their job. It is also their job to maintain the physical infrastructure, which is a separate role. You can see that there's also a local opportunity over the longer term. You may hear from others about co-location, where you can actually create opportunities connecting renewable energy generation to batteries. Well, actually, they usually talk about attaching batteries to renewable projects. We see it the other way around, given our genesis. There are also opportunities to create contracts with local consumption. And if we have a diversified network, no one project will swamp the local opportunity too significantly and therefore dilute. And that's why we don't have, say, 3 or 4 300 megawatt projects targeted. Is why we have many smaller projects, or even if they are very large. The incremental pipeline is shown in the light blue. The existing projects are shown in the dark blue. Next slide, please. Why Gresham House? We probably have the largest team involved in this area, and through time, and myself and my team have developed a deep understanding of how renewable projects are built. And I think that's really important, because battery projects are built in a very similar way. The technologies that are used actually are very similar. The processes of developing them, where you put them on the grid, can be very similar. But you do need to have this understanding of the merchant power markets to be able to understand the opportunity and get in front of it, which I think we've achieved over the last 5 years since we entered the market. even though we only IPO'd in 2018. And so that is really where I think we have our cachet. We've developed some very deep relationships with the key stakeholders in this industry, from National Grid to the government, to Ofgem, as well as the different operators and other stakeholders in the market. We've also been awarded our A+ rating from the UNPRI ranking system. Delighted with that, as well as having the Green Economy mark as well from the London Stock Exchange. So in summary, we've got a lot of portfolio strength. We're the largest by a factor of 3 at the moment in Great Britain, with a leading market share, a highly diversified portfolio, a lot of scale. We've got a track record. We entered the market first back in 2015. We see a lot of extra values that we can pull. One I haven't mentioned, just for additive features, is we build on our projects initially at 1 to 1.5 hours, but we believe the trading environment will allow 2 to 4 hour batteries in the longer term. And we look forward to taking advantage of that, but that's not in our value and our NAV at the moment. And we think the route to market we've taken in terms of an equity listing has actually been very beneficial to us. In the interest of time, I'll pause there, but there are a couple of other slides that you can read in your own time, but I hope that was interesting.
Thank you very much, Ben. That was a whirlwind tour, if you pardon the pun. We'll now finally move on to Jonathan at SDCL, talking about the final part of the chain, I guess, is the consumption side, and how, people, we've got a growing population and people demand more and more energy. So it's a key part of the chain in making that as efficient as possible. So over to you, Jonathan.
Thank you. And thank you to Edison for inviting me to come and talk today. Very interesting presentation from Chris on generation and Ben on storage. I think our view or our outlook really is about energy at the point of use. So, going, if you like, sort of to the next stage beyond the grid as to where energy is actually used. So absolutely thematically great to put us at the end. I think the observations that sit underneath the investment thesis are that outside of renewables, generation historically, and to a great degree today in Europe and North America, transmission and distribution, those 3 things put together, generation, transmission and distribution, result in some relatively significant losses in energy by the time it gets to the end user in the building or indeed in the transport sector. And then once the energy is at the point of use, energy is potentially used rather inefficiently. And then ways of addressing both the efficiency of supply and the efficiency with which energy is used. And indeed, and this touches on some of the intersections with excellent presentations, the way in which energy is even distributed. So please, if you wouldn't mind going on to the next slide. Just to talk you through very quickly where our investment company is. Again, we launched in December 2018 as an IPO. The company today has actually total assets near 600 million. We've raised 535 million of equity capital since IPO. The company has around 30 project or portfolio investments, but some of those underlying investments, if you drill down into them, relate to portfolios of projects and indeed portfolios of customers. I'll go on to some of that detail in a second, but there is tremendous diversification in this portfolio, which generally is about sort of clean energy supply directly to the point of use, efficient distribution, and efficient demand reduction. The company, as I said, listed in December 2018. It was the first specialist dedicated energy efficiency investment company to list on the main market of the London Stock Exchange. I think we positioned the company, and this is exactly where it remains, really as able to take advantage of some very significant long-term structural trends in the market. So, constrained energy supply, relatively high delivered cost of energy, a significant emission reduction target increase both at government and corporate level. And we said originally that actually, all of this without subsidy, generally speaking, so necessary in a lot of cases avoiding regulatory headwinds. I think what we didn't anticipate as much, and I'll come on to this later, is the degree of regulatory tailwind, or at least policy tailwind, from Europe and North America now, which has recognized energy efficiency for the next decade as at least as important as renewables was for the last. So we're very much looking forward to playing an important role in the scaling up of this sector. So, I mean, the first point is we launched as the first dedicated vehicle in the market. The second point is that we've now created, at least at Basecamp, a portfolio of relative scale, very high levels of diversification. And the portfolio characteristics, although we touch on a lot of different types of projects in quite a few markets, fundamentally, the portfolio is all about investing in projects which are predominantly, largely, or all contracted, long-term, medium to long-term income streams with relatively low credit, technology, regulatory, or market risk. So what we're looking to create is a long-term, stable, predictable return profile for our investors. And we said that the total return target for the company would be 7 to 8% for when we listed, and we're on track. We underpinned that total return target with a dividend target. We met that dividend target in our first full year of operation. 31st of March 2020 was our first full financial year, and that we delivered 5 pence per share on our dividend. That was covered both by earnings and by cash. And we stepped up our dividend target from 5 to 5.5p for the current financial year, and indeed moved to quarterly dividends. The medium to long-term plan is to stay on track with regards to earnings and cash cover for our dividends. We're a very experienced management team when it comes to energy efficiency. We've been investing in energy efficiency for the best part of a decade, during which we've raised a little over $1 billion for investment in the sector. We're originally backed by governments, the UK, Irish, New York, Singapore governments, European Investment Bank, and now a very broad range of participants from the capital markets, which we're delighted with the support. If you wouldn't mind moving on to the next slide, Rob. Very quickly, I mean, energy efficiency, I think, sits alongside, the social infrastructure funds like HICL, which I was privileged to be involved with the launch of back in 2006, and renewables. It definitely sits alongside, I would say, the more sort of established infrastructure investment subsectors like social infrastructure and renewables, with a few differences. Our revenue streams come by and large from commercial and industrial counterparties, so medium to long-term contracts, but not serving government or the grid, but really the end user. We do have public sector income and revenues and clients, but as much, if not more, in the commercial and industrial sector. We have relatively low levels of gearing in our portfolio companies, or indeed in the investment company. And we have, I would say, sort of a medium-term contracting period in a lot of our contracts. So the weighted average term of our contracts is around 14 years at the moment, compared to some longer-term plays in the renewables and social infrastructure. What it does is it creates a very cash-generative investment strategy for us, which allows us not just to cover our dividend, but also to use cash to reinvest in opportunities coming through. So some opportunities for incremental growth. Rob, please, if you wouldn't mind moving forward. I mean, the overall story, investment thesis, something that binds everything we do together, as I said, is sort of, we think about this supply, distribution, and end use. We see the past as centralized and relatively inefficient. We see the future as more decentralized and more efficient in the way that energy is delivered to buildings. So on-site generation using biogas, recycled gases, even high efficiency natural gas, rooftop solar power, renewable heat technologies. Very excited to see Boris's 600,000 heat pumps a year coming into the residential market in the UK, for example, today. So I'd say supply to the point of use, cheaper, cleaner, more reliable, cutting out the grid, cutting out the carbon and the cost associated with it, and delivering energy directly to the end user on a reliable, low carbon, low cost basis is key to our investment strategy. The other side of our investment strategy is helping companies and buildings to reduce the amount of energy they waste through inefficient lighting, heating, ventilation, air conditioning, and so on. So it's about providing buildings and even transport infrastructure now with efficient supply and also reducing the waste on the demand side. Please, Rob, if you wouldn't mind moving to the next slide. Thank you. As I said, I mean, energy efficiency has been a little sibling, if you like, to the renewables sector for the last decade, which has really dominated investment flows. Having said that, 2020, I think, is a policy earthquake. It was announced, at least by the European Commission, and it's been picked up by the Biden climate policy as the #1 unrivaled policy destination for the European Commission. The European Commission has said that there is no way that they'll achieve their 2030 carbon emission reduction targets, energy market design, or indeed economic goals without reducing the amount of energy wasted in the built environment, which is 40% of all energy and carbon. So we're delighted to see the European Commission seize on energy efficiency as its pillar policy for the next decade. And indeed, we expect to see more of the same in the US and even potentially in the UK one day too. Please carry on, Rob. In terms of ESG, which I know is the topic of today's webinar, the ESG story has moved on. The name of our company is Sustainable Development Capital. Everybody knows energy efficiency is the biggest bang for the buck from a carbon emission reduction perspective. But clearly, today's reporting environment requires verification and disclosures. And we're pleased on the 1st of October to announce to publish an ESG report, which contained, during the ramp-up phase, I should hasten to add, the scale of the CO2 emission reductions, the megawatts of clean energy, the negawatts of energy demand that we're taking out of the system, job creation, and so on. So we're delighted to take everybody through that report. It's on our website. Rob, if you wouldn't mind going forward. Skipping over this, as I said, we've invested in quite a broad portfolio now of projects that's expanding. Sorry, if you go on, Robert, if you don't mind, onto the next slide. As I said, we've got about 30 individual portfolio investments, but some of these investments actually go very, very deep and are hugely diversified. We just acquired the biogas distribution network for Stockholm about 2 or 3 weeks ago. Is it listed here, for example, as one project, Stockholm Grid, but it doesn't portray the fact that we have 58,000 customers. So in terms of revenue diversification, it's a very strong story. Likewise, the Oliver Spanish cogeneration project we have listed there has 9 projects in it. And we have, for example, Spark, US Energy Efficiency actually has 256 contracts in 36 states in the US. So we are very deeply diversified across our portfolio. Please, Rob, I'll move to the next slide. Thank you. I mean, in terms of where we see all of this going forward, I think efficient supply is a very large part of it. Demand side management is a very, very big part of it too. We've got a very significant pipeline of opportunities. I'm pleased to say that the 600 million of total assets today, roughly, I think is, as I said, sort of a very good stepping stone into a broadening and diversifying portfolio of EBITDA increasing acquisitions that we're looking to make. Rob, if you wouldn't mind flicking forward. If you can just flick forward a few more slides. Just go on to the back one and I'll conclude. Sorry, not the important notice. I know that's extremely exciting for everybody. There we go, thank you. But just a sort of quick update on where we are today. Broadly diversified, UK about 1/3 of our portfolio commitments, continental Europe about 1/3, and North America about 1/3. We hedge everything back into sterling, and that hedging strategy has worked extremely well to date. We have an absolutely excellent non-executive board of directors. Tony Roper, who's our non-executive chairman, people will know from his time at Hickel. Chris Knowles, people may know from his time at the European Investment Bank as head of climate finance. Helen Clarkson, people may know because she's the chief executive of the Climate Group, the world's largest NGO for ESG, Rob, for climate change. And people will know Emma Griffin from her time in the investment trust market for many, many years. So with that, I shall conclude, but thank Edison for allowing us to pick up the end of the chain, if you like, in terms of where the energy ends up, both in terms of buildings and transport.
Excellent. Thanks for that, Jonathan. And so that rounds up the sort of formal presentation part. So it's over to the participants, listeners at this webinar now for any questions you may have. So you can submit those through the Q&A button, or you can raise your hand. We did have one in earlier, and they were asking about the impact of COVID and what that has meant for demand, and has that impacted NAVs, and also has that impacted discount rates? So maybe the speakers could in turn talk about that, and any perceived impacts on NAVs from COVID, or those moves in the key in those key variables. Maybe start with Chris, and you sort of go round.
Sure. I mean, it's clearly impacted valuations. I think there's no surprise that power price forecasts have reduced as a result of COVID, the impact of COVID. Consequently, the downward movement on valuations for funds like JLEN has been impacted by that. So there's a clear link. Forecasters do their thing. Unfortunately, we have to use their curves, and that's essentially the best estimate that we have for the next 15 or 20 years. We publish our curve, which is a blend of a number of market consultants. The discount rate changes, probably less linked per se to COVID, more so just I think general appetite and risk assessment of these investments. We've seen a downward move in discount rates for the core renewable sectors, wind and solar, for example. But for trusts like JLEN, we move into other sectors which still have a healthy discount rate for the risk involved.
Great, thanks.
Quick comments. So in normal circumstances, the one of the statements we make is in our presentation is that our revenues are not impacted by the level of power prices, especially the average daily power price. That is sort of where a lot of renewable funds talk about, but it is by the spread in power prices. However, unusually, the gas price fell so far and so quickly that the forecasts for where the price would set at the peaks of the day, if you like, came down as a function of that mostly being set by gas, and therefore impacted the assumptions for upside volatility in power, and therefore impacted the revenue projections, mostly at the front end of curves. But there's a degree, I suppose, normal of any forecaster's tendencies to extrapolate that into the future, and that's impacted also the revenue assumptions that we also get from third parties. The irony is that actually we saw this point of inflection, and the likelihood is that our revenues are actually improving, but we are loyal to our processes, and so we've actually seen the NAV impacted in the first half from that. Other factors actually led to a roughly unchanged NAV over the first 9 months of the year, but there has been an impact specifically from COVID and gas prices underlying that. So yeah, that's my comment.
Yeah, I mean,
Jonathan.
Yeah, I mean, the conclusion for us has been that we've been defensive against COVID. Some reasons for that is we have an aversion, if we can achieve it, to demand or market price risk generally. So generally, our portfolio has been very defensive because it's little affected by fluctuations in demand or market price. I would say that there have been some short-term fluctuations, but where there have been, they almost always covered through some form of regulated true up over the medium to long run. So we have not seen any unmitigated demand or market price risk that's material to our performance this year. I mean, that is not a moment, however, for us to be not to be mindful. I mean, we have seen some short-term fluctuations. One of the reasons we are relatively defensive, apart from emphasizing availability style or regulated fixed revenues in our portfolio generally, one of the reasons for that is that we're providing essential energy services to counterparties directly to the point of use. That's electricity, heat and power, without which counterparties can't function. And those counterparties have traditionally been selected on the basis that they themselves are critical to their economy. So they may be data centers or hospitals on the smaller end of our portfolio, or manufacturers at the larger end of the portfolio that are producing things like agriculture or absolutely core materials for manufacturing in the US. So so far this year it's been very defensive against COVID, but clearly it's going to be putting pressure on the market as a whole. But from a discount rate perspective, specifically related to our portfolio, and a valuation perspective, we've exhibited defensive characteristics this year.
Great. And on the discount rates, actually, we've got another question. Obviously, there's been a reassessment of risk, but they're asking, how would, what do negative real interest rates mean? How do they affect the discount rates? Are you taking those into account very much, or are you sort of, because you seem to be using quite high discount rates relative to, I guess, some of the bond yields we're seeing out there. I guess that's the implication of the question.
Is that a follow-up question you'd like me to?
Yeah, I mean, well, yeah, please go ahead, Jonathan. And anybody else, Chris, maybe you sort of had more swings from that area.
We have, at least on our portfolio, so far we actually published in June our annual report, but we had maintained a very, very stable view on discount rates. At that point, we were reporting on the period to the 31st of March, which is obviously a couple of weeks into the COVID crisis. But as it happens, I think that we've generally taken a policy of holding our discount rates stable. It's specific risk we're looking at with regards to the counterparty and these project risks that we face. And you're right that there has been a contraction in discount rates during the course of the year, but I think different companies will take a prudent approach. We report, as it happens, on the 8th of December for our results, I believe. So we'll be disclosing our discount rates at that point. But we're not looking at sort of radical changes at this point. But I think there's a general story that securing in the infrastructure sector could be considered more favourably in a reduced interest rate environment. I think it's a fair comment.
Great. Does anybody else want to address that, or I can move on to another question? How should investors think about the long but often time-limited nature of the contracted income? Should such contracts be viewed as annuities?
Maybe I can just start it, because this might have a slight reference to some of the subsidies, perhaps that renewable energy generators, certainly the early commission ones, enjoy, quite rightly so. They are time limited in nature. That's the nature of the subsidies. However, certainly for core renewables such as wind and solar, we've seen fund managers and funds take the assumptions that there is life after a subsidy, and I think that's rightly so for low technology sectors such as wind and solar, which clearly the sun will still shine and the wind will still blow. The initial capital investment is paid off, so the marginal cost of running these sorts of facilities is actually very, very low. And you'll see assumptions for wind to have what we call asset life extensions of probably around 5 years, solar perhaps 10 years, where the income generated by those assets will continue to be accounted for in the valuation for that fund beyond the end of the subsidy life.
Great, thanks for that. Maybe one here for Ben. how have the raw component price of batteries fallen? And can that shift continue, for instance, with greater demand from the car industry?
Really good question. Over the last 10 years or so, we've seen battery prices fall about 80%. And that has actually not been heavily driven by improvements of the technology in terms of the core technology, the chemistry. It's been mostly driven by the fact that we're not making small batteries, cylindrical cells or things like that as much for the industry as larger cells that we use in cars or in energy storage, which means there's less packaging per component. There's the factories are a heck of a lot larger, they're much more automated, and there's really these manufacturing improvements and design improvements that have led to the big collapse in prices. The prices have sort of started to fall more slowly now, and we expect more gentle reductions in prices, let's say 3 to 5% over the medium term, with probably the biggest driver in terms of value coming from actually improved cycle life. So you'll have to recycle them or top them up or augment them, as we call it, less often. So we don't see dramatic changes. And just as another point, a lot of people fear that if we build a battery project today, the one that comes in tomorrow is going to be, sort of half the price. The batteries are only about 30% of the value of a project, the rest being fairly standard electrical components from, as well as other aspects of a site, civil works and labor. So it's connection equipment, inverters and transformers, and general containerization as well, and other auxiliary things. So more gentle going forwards. I don't see any disruptive technology other than potentially fairly meaningful improvements in cycle life. But other than that, don't see any dramatic shifts. And even if it went to zero, we're talking about 30% of the project's value.
And there was a follow-up on battery storage, just asking, do the panelists have a view on sort of potential green hydrogen generation? I know we've had some comments from the government today on that, versus battery storage as an alternative destination for energy supply. So maybe you could
happy to comment briefly if you like. The reality is that we don't see, look, I mean, there are bound to be opportunities, and if the governments want to back this technology, it's going to have an opportunity because it's going to be made economic, as feed-in tariffs tend to do, whether it's whatever mechanism, grants or whatever. But fundamentally, at the technology level, we look at round-trip efficiency as well as lots of other factors for any form of energy storage. And you have to consume electricity, which is probably generated by renewables, which you could put into a battery and get over 90% of it back. Not at the final point of consumption, Jonathan, but certainly in terms of the grid point, as opposed to using that electricity to then generate hydrogen at a level of efficiency that I'm not actually fully aware of. But then you then store it somewhere. There's going to be a degree of inefficiency and cost associated with that. And then you probably put it through a fuel cell, which is 60% efficient. I personally don't get it. And in the context of the UK, perhaps in other countries, it may make sense for long-term responses to undersupply of renewables. And I do get it from a sense of as a fuel for a green fuel for where energy density is required. So it's probably about 7 times more energy dense than a battery. So if you want to put them into a ship, a long-haul truck, or a plane, if you trust it, that does probably make sense.
Right.
I was just going to offer a short answer on that one too, which is I think that there's a fantastic role for hydrogen, and there already is a fantastic role for hydrogen in the chemical industry and refineries. You're going to find the best bang for the buck, green or otherwise, in industry and industrial clusters. I think there's a lot of discussions about other applications, including taking intermittent renewable generation. You'd need to double electrical generation in Europe in order to fulfill the hydrogen valley sort of vision. So I think the short story is I think it's probably apples and pears. Both will thrive, I'm sure, and indeed there'll be a fantastic opportunity for hydrogen directly to the point of use in industry for sure.
I think that's right. We're going to need both of these and more to hit our net zero by 2050. There'll be some technologies which we haven't even thought of yet, which will play a role in decades to come. But for sure, both hydrogen and battery storage will play a key role Battery storage, clearly, I think more in the short term is more mature market, more developed technology, but there's no doubt there's a role to play for green hydrogen somewhere.
Yeah, I think there's still trying to do there's people trying to develop technology to crack methane, aren't they, into to hydrogen, but it's not been quite industrialized yet. But who knows? Just another one. Obviously, we're seeing a sort of a shift in the markets generally. You know, sort of growth to value, and maybe people are seeing more fiscal response. And I suppose this question again, it's coming back to interest rates, but they're thinking, you know, are we going to maybe see rising real interest rates, and would that erode your margins? I suppose if I were answering, I guess there might be some historic impact, but I guess the new money you're investing would be done at reset prices. But I mean, I'd be interested in your comments on that.
I mean, I'll offer a quick one. I mean, I think we feel that you're right in whether or not there's inflation, any inflation upside in the investments we're making, or the ability to continue to make investments through the cycle, benefiting from the point that you made. You know, these are defensive things. I mean, one of the other things I think probably marks out these sorts of strategies is investing at rates of return which are offering a significant margin over risk-free or over inflation rates at the moment. So I do feel investing at the 7 to 8% IRR, provided that the revenue is sufficiently secure, with sufficiently little additional risk you're taking on from market or demand in particular. I think that certainly the strategy we're running is defensive, and you know, will sustain in a not necessarily just no or negative, but also low or moderate interest rate or inflation environment.
Who wants to go next, Chris or Ben?
In our specific case, we're using a 10.75% discount rate. It's a huge premium to you know, real rates. I think the bigger driver, unless we see a sharp move upwards, is a benefit from yield compression over time, as well as benefiting from just the ongoing revaluation because of the sort of exclusive portfolio that we've got, or pipeline that we've got, being acquired at a premium still to that. So I think there's a lot of value left there. But I appreciate that rising rates increases discount rates at some level, and has an impact on valuations, at least at a mathematical level. Yeah.
Yes, and yeah, similar response. I mean, we have clearly a range of technologies within JLEN, each of which has its own discount rates, which are impacted by a variety of measures. But yeah, no doubt that plays some role in it, but there are lots of other factors involved in determining appropriate discount rates for these sectors.
Excellent. Well, I think we're sort of slightly overrun now. We've had I think a very good Q&A session there. I would encourage you know, anybody who has any follow-up questions to contact you know, myself or any of the team at Edison, and we can then pass those on. If you need to get in touch with any of the companies presenting here, we'll be very happy to facilitate that. And once more, I'd just like to thank our presenters. A really interesting seminar. Thank you very much, everybody.